Investment in securities market is subject to market risks. Read all the related documents carefully before investing.
How exactly does compounding work, and why does compounding enrich investors so powerfully?
Stocks for 10 years or more allows the power of compounding to play out by letting the winning stocks in the portfolio to run, right? So over a longer period of time, the portfolio becomes dominated by winning stocks, while losing stocks, essentially underperformers, because they keep on declining, and eventually they become smaller and smaller as a portion of your total portfolio, to the point that their contribution to the overall portfolio return will become almost inconsequential.
Hi there, my name is Saurabh Mukherjee, and it's my privilege to welcome you to the second episode of our podcast series, Guru Mantra with Saurabh. I work for Marcellus Investment Managers, and it's my privilege to invite a colleague, Krishnan, who also looks after our investment advisory vertical, to join the podcast. Welcome, Krishnan. Welcome to the second episode of Guru Mantra. Now, in the first episode, we discussed the importance of allocating to equities. We highlighted that equities is the only asset class in India which gives you returns well in excess of inflation over the last 10 and 20 years. In this podcast, we focus on the benefits of long-term compounding. So, Krishna, let's begin with the question on how early should an investor start with equities, and what is the typical period of time someone who enters the stock market should stay invested in Indian shares.
Sure. So, as we discussed in the last podcast, it's extremely important, for nearly all Indian investors to have meaningful allocation towards equities. Now, since equities, like we also discussed, are the riskier when you compare to other asset classes, they require patience to stay invested, to ride out the volatility, and to get the full benefit of compounding of returns, right? So just to take an example, right? So, a compounding of 15%, right? Compounding at 15% with a 1 lakh invested corpus means that, it would, the initial invested corpus would grow to around 4 lakhs in 10 years.
Amazing.
And in another 5 years, it grows to 8 lakhs. And then, another 5 years, so that is 20 years, it grows to almost 16 lakhs.
Wow.
So that's the power of compounding. So you start with the initial corpus of 1 lakh, and you would have grown it to 16 lakhs.
In 20 years.
In 20 years,
wow,
compounding at 15%.
Amazing. So folks, let me reiterate that. If you start today, so assume for instance we are sitting in 2023, you start today with 1 lakh investment. By 2043, your 1 lakh would have become 16 lakhs, right? And what Krishnan is describing is the power of long-term compounding. In case you want to do this quick maths in your head, it's called the rule of 72. Take 72, divide by 72, whatever rate you're compounding at, that's the number of years in which your money will double. So if the rate of compounding is 15%, 15% is the rate of compounding used by Krishnan in his example. 72 divided by 15 is roughly 5 years. Every 5 years, your money is going to double, and that's the power of the Indian stock market, right? You invest in the Indian stock market, stay invested for 10 or 20 years. You'll see your money grow by not 1 or 2x. You're seeing your money grow by 14, 15, 20x, and that's why the stock market becomes a mode of a long-term compounding. Now, Krishnan, a typical career in India is 40-45 years. So if you can just take this example forward and explain it in the context of retirement planning.
Sure. So equities should ideally be part of one's retirement planning, right? So, and this is because the long-term horizon, which one requires for investing in equities, is automatically because you are basically investing for your retirement. You have a good 20-25 years, even for someone who's starting to invest at say 30 years, you have a good 20-25 years till you retire, right? So it's equity as an asset class is ideally suited for retirement planning, and obviously we know that equities compared to other asset classes is the only one which can help you grow your wealth over and above inflation. Right. So for someone aged 30, investing say around 4 lakhs in equities, and assuming that again they are just compounding at say 12% every year, roughly comparable to the Nifty 50 returns like we discussed
Yes.
over the last decade,
Yes.
will end up with approximately 1.2 crores by the time they retire at the age of 60 years.
So just tease out the assumptions here for me. He's starting at age 30.
Yes.
Retiring at age 60. And he's starting with a corpus of
He's starting with a corpus of 4 lakhs.
4 lakhs. And then he's adding more money each year, or just the 4 lakhs?
Just the 4 lakhs.
Just the 4 lakhs started at age 60. By 4 lakhs starting at age 30. By age 60, that's becoming
1.2 crores.
unbelievable. So again, you see the power of long-term compounding, and remember, we are not talking about some heroic compounding rate. 12% की बात कर रहे हैं, निफ्टी वाली रिटर्न की बात कर रहे हैं. 12%, 12% compounding from age 30 to age 60 makes you a crorepati, provided you started with a 4 lakh allocation. Now, Krishna, let's get into the maths here. Why is this happening? How exactly does compounding work, and why does compounding enrich investors so powerfully?
Sure. So, holding a portfolio of stocks for 10 years or more allows, the power of compounding to play out by letting the winning stocks in the portfolio to run, right? So, over a longer period of time, the portfolio becomes dominated by winning stocks, while losing stocks, essentially underperformers, because they keep on declining and eventually they become smaller and smaller as a portion of your total portfolio, to the point that their contribution to the overall portfolio return will become almost inconsequential, right? So essentially the positive contribution from the winners disproportionately outweighs the negative contribution from the underperformers. So again, this is hard. It kind of drives the long-term compounding of the portfolio.
So if you take a 2-stock portfolio, 100 रुपए की portfolio, if you put 50 rupees in stock A, 50 rupees in stock B. So even if stock B goes to 0, but stock A compounds at say 26%, right? Stock A में 50 rupees I put in, 10 years hence that 50 becomes 500 rupees.
Correct.
I'd put in 100 rupees initially. Out of the 100, I lost half of it overnight. But even then, 10 years out, I will end up with 500 rupees because one of the 2 stocks worked out, even though the other stock lost out. So 100 becoming 500 over 10 years, that's a compounded annual CAGR of 18%, right?
Correct.
18%. So once again, folks, we discussed in the preceding example, at age 30 you start with 4 lakh investment. At age 60 you're worth 1.2 crores. Why? Because you got 12% compounded. Right? Here I'm giving an example where you get 18% compounded even though half of your portfolio gets wiped out. Why do you end up with 18% compounding? Because the other half of your portfolio works out nicely. Now this is an example of how compounding works in a diversified portfolio where some of your stocks don't work but the rest of the stocks work. So Krishna, I actually, whilst I was very poor in Hindi in the early years in school, by the time I did my class 10, I was close to the class topper in Hindi. And one of the things I learned that in Hindi, compounding is called, compound interest rate is called Chakravarti Vyaj. Wow. So this is an example of Chakravarti compounding, but at a portfolio level, आपको 18% compounding मिल रही है because आप 2 stock, मतलब multiple stocks लेके portfolio चला रहे हो. Now, any guidance on the period of time people should stay invested? काफी लोग long term investing की बात करते हैं. Long term investing कितनी साल की बात कर रहे हैं हम?
So again, for equities, the longer you stay invested, the better. Right? So, again, if you have a horizon of more than 10 years, that's probably the best. But in no case should it be less than 5 years.
Right.
So again, if you ask me, I would say, keep invested as long as possible, or stay invested as long as possible, and keep almost an indefinite horizon as much as possible. But definitely not less than 5 years.
So just to again put this in another context, if you use the rule of 72, assume कीजिए your rate of compounding is say 13-14%. The rule of 72 will mean 72 divided by 14-15 over 5 years. You're broadly giving your money a chance to double, right? So if you want to see decent returns to investing, at least give yourself a 5-year horizon. And just to link this to the message from the first podcast, make equities the chunkiest part of your asset allocation. Set aside enough monies to cover your next 2 to 3 years of expenses, your outgoes. Rest of it should go into equities. And when you enter the stock market, give it at least 5 years. That brings us to the end of the second episode of Guru Mantra with Saurabh. In the third episode, we will get into the nitty-gritties of disciplined long-term investing. Thank you so much for joining us.